We are now recording. So Paul, now the show is yours. And so he's going to chat for about 20-30 minutes, and then we'll open it up for any questions you guys may have. So hopefully you have pen and paper, jot down some questions, pick his brain, because this has been a crazy year, and I know he's really excited to just be able to answer any questions you guys might have. I'll watch the clock, but I'm sure you'll be just fine. And then, yeah, we'll have, 20-30 minutes of questions. And if we have none, we'll wrap things up right around 7 o'clock. So Paul, on to you.
Thank you. So Jenny didn't know what to do. When I first met her, she was overwhelmed and unsure of herself. She felt financially vulnerable after going through a recent divorce. And even though she was a successful sales rep making a good living, numbers were just never really her thing. And so she was nervous and she didn't know what to do. And I assured her that we could get our arms around this. We could put together some strategies and lay out a plan that she could understand and execute. And I told her the same thing I tell people all the time. Everybody's got their strengths, and everybody's got their things they struggle with. This happens to be a strength for me, but it wasn't for her. And so I was in a position to help her. And I told her that when you look at this, successful money management is a lifelong process. And it involves all kinds of different tasks, all kinds of different strategies. And I'm just going to show you 6 of them here just to kind of start out. These are some of the things that we talked about. But when you think about what it takes to be successful at managing your money and making it every day, number 1 is just having the ability to earn a living. And that one's kind of on all of you. But the next one is in the discipline to save on a regular basis is just something that you have to work on over time, especially if you weren't shown that when you were younger. The third thing starts getting into the meat of how we do things, and that's either having the skill to invest on your own or the knowledge to select a competent and trustworthy professional to help you. Selecting the right type of investment account is a topic that we're going to talk about a little bit later. I'm pretty passionate about it, and you'll probably see that. But then just something as simple as how do you balance short-term savings, college savings, retirement savings? How do you know how much money to allocate to each of those things? And finally, once you get to retirement, how do you navigate retirement? How do you know how much money to take off of your investments? How do you know if you're going to be okay? And how do you handle potential inheritances in a tax-efficient manner? So we're going to talk about 3 of these things today. And then we'll cover any ground that you want to from there, but those 3 things will be how we start. And so let's talk a little bit about just investing and what that entails. And I think probably the best thing to do is let's talk about what's happened so far in 2020, because we have crammed a lot into just a very short period of time here. So if any of you have investments out there, I'm sure it caught your attention. The year started off just nice and calm. January was up a little bit. February was up a little bit. Then we get to about the 3rd week of February, and the market started coming down, and it was all anxiety around this global pandemic and trying to figure out what that means, and around the conversation of do we just shut businesses down and send people home? And the market dropped about 37% from its high to its low in March in about 4 weeks, 4 to 5 weeks. That's the fastest that the market's ever gone from a bull market to a bear market. It's never happened that fast ever. And so it was just breathtaking how fast things were going down. And then it turned around and came up almost as fast. Well, if you're an investor, how do you know what to do with those types of things? We're going to talk about that a little bit, and we'll talk about strategies for how you protect your money in those situations, and how you go about maybe being a little opportunistic too. So But one of the things I want to do real quick is I'm going to share a screen. Let's see if this is going to, I think I can make this show up here. This is, oops. Bear with me just a second. I'm trying to figure out which one of these fellows I'm going to share next. There it is. I apologize. So this is a book that I published just a couple of years ago, and it's called Financial Secrets Revealed. And the reason that I bring this up is because it's relevant to helping you have some success with what you do. And this is a book that's just a story about a couple of young advisors that get into the business and what they learn about how the business works. So it's not a book on investment strategies. It's a book on understanding how this business works, because it's very complicated. And the last chapter of the book is really just a list of questions that you can ask to a potential advisor to determine if they're working for you or if they're working just as a salesperson for their company. And so we'll talk some more about this in a little bit, but you're going to have to, one of the decisions you're going to have to make is, do you do your investments on your own, or do you find somebody to help you? And if you're going to find somebody to help you, how do you know if they're really working for you or if they're just a salesman selling what their company tells them to sell? So let's just talk about investment strategies for a minute first, and then we'll circle back to the book a little bit later, and you'll all have a chance to get your hands on that when we get to the end of this. So. But one of the things that I run into all the time, I've been doing this for 24 years, and so I've seen three bear markets where the markets drop 20% or more, and I've watched people's accounts go down at sometimes just dizzying speed, and so I've seen this 3 times, and in every situation I have a story where I can tell you that somebody got nervous and sold at the bottom and lost a lot of money. And it's heartbreaking to watch that happen. But the guidance that you've heard, I'm sure, that says it's a good idea to put an allocation out there and don't move it around too much, is a good idea. You'll hear people say stay invested when the markets get turbulent. And I'll tell you that, first of all, that's easier said than done, because if you've been through this, you know that sometimes it takes nerves of steel to stay in the game when it looks like there's nothing but down days in the market. So the key to, one of the big keys to being successful with investing is to have a plan in place that you believe in, that makes sense to you, and that you can execute over time, because you're going to see markets and market volatility over and over again, and if you're always reacting to the market going up or down, it can make it hard for you to have success over time. So having a plan in place, let's just assume that you've got 20 years to retirement, so you've got 20 years to save before retirement. And then let's assume that you're going to live maybe 25 years in retirement. That's a 45-year time period. And during the next 45 years, there are probably going to be 4, 5, or 6 bear markets where it's just going to look like the market is going down and there's no recovering. And it's a good idea to just kind of get comfortable that those things are going to come. And if you've got the right strategies in place, then you won't get too wound up when that happens. And one of those strategies includes having some money put aside for emergencies. And you've all heard this, have an emergency bucket. And people ask me all the time, Should I have 3 months worth of savings in there or 6 months worth of savings in there? And I tell them, 6 months worth of savings is a really good idea. But if you don't have any, let's just start with something. Let's just start building something up over time. But if you've got some savings like that and you lose your job or something happens that requires some emergency funds, you can tap into those savings without having to sell investments. And that way, if investments are down at the time, then you're not selling them when they're low. So step number one in putting together a good strategy is having an emergency fund in place and being prepared in case something happens. Step number two is creating a nice allocation for your investments. And the allocation could be part stocks, part bonds, part real estate, part cash. And it'll depend on the time frame that you're dealing with. So if you've got a ways to go to retirement, you're going to be able to be a little bit more aggressive with your retirement money than you would with some of your shorter term savings and investment money. So the time horizon that you've got to deal with is a really important factor to dictate how we build a portfolio and how much risk we take. And right behind that, and people don't talk about this enough, I don't think, the time horizon can help someone like me with the numbers and to get the allocations and risk profile right. But the other thing that's hard to gauge is how much volatility can you as an individual take. And so I'll describe it as if you go out here to Worlds of Fun and you get on they've got 5 or 6 different roller coasters you can get on out there. And some of them are just nice and easy and they don't move much. And those are the little kiddie roller coasters. And then some of them are pretty scary. They've got some steep climbs and some steep drops and turns. And I think everybody, when they get out there, if you're a roller coaster person, then you decide which one of those do you like to do. And it's a little bit the same with investing. Having some growth type investments or some more risk in your portfolio is probably going to give you the highest returns over time. But if you can't handle the ups and downs as the market's bouncing around between now and the destination, then it doesn't do a lot of good to have those things because you won't stay in them when you need to. So understanding your time horizon is number one, but right behind that is understanding your risk tolerance and whether or not you can take it if you get a statement where your account's down 1 month in a row, 2 months in a row, 3 months in a row. And sometimes you don't even recognize what your risk tolerance is until you get in the middle of a time period where things get rough. But that's an important one to pay attention to. So you got to move at your speed and invest at your speed. And that's an important thing to keep in mind. So I'm going to look at my notes here for just a second, see what I want to do next. So, I want to talk about so picking investments, whether it's individual stocks or mutual funds, and building out your choice, all the players that you're going to use for your investment portfolio is important. But there are also a number of different kinds of investing buckets that you can use. And by buckets, I mean accounts, but I like to call them buckets. So if your company has a retirement account, that's a 401k or something like that. That's a certain kind of bucket. If you have an individual retirement account, which is an IRA, that's another kind of bucket. If you have just a regular taxable account, that's another kind of bucket. And so one of the things that people don't pay as much attention to as I would like to see is which buckets are they using. And we're going to talk about this a little bit because I get a little excited about one of these, and so my favorite bucket is a Roth IRA, and I'm going to show you that here in just a second. So hopefully I'm sharing a screen that is titled at the top that says winner of the Best Bucket Award, the Roth IRA wins. And I want to talk about why I like this. And I tell people every chance I get, the Roth IRA is by far my favorite bucket because it's the most versatile in terms of the things that it'll allow us to do. And so if you're saving for retirement, there's a good chance that you're using a company retirement plan or you're using an IRA. And the reason that you use those is because you get a tax deduction on those fellows when you put your money in. So there's some incentive for you to save money along the way and to put money away for retirement. And so that's great. You're getting a tax break on the money that you're putting in now. But the thing that I want to talk about is the difference between what a regular IRA is and what a Roth IRA is. With a regular IRA, you get a tax deduction when you put your money in. Your money grows tax deferred until you get to retirement. And then when you get into retirement and you pull money out, then you have to settle up with Uncle Sam, and you're going to have taxes due on anything that you take out of the bucket. So as long as the money stays in the bucket, it's tax deferred, there's no taxes. But as soon as you pull $1 out for yourself or to pay some of your bills, Uncle Sam's going to have his hand out and he's going to want a piece of that in taxes. And so it was fun getting the tax deduction early on the seed money that you were putting in, but as that grew over time, the money coming out the tax can get to be quite a bit. So the Roth IRA works just the opposite of that. With a Roth IRA, you don't get a tax deduction on the money that you put in today. That's no fun. Everybody likes to have a little bit of break on their taxes. So with a Roth IRA, if you put money away, no tax deduction. But the money grows tax deferred, and then when you take it out later, it comes out tax-free as long as you've met a couple of little criteria. And we'll go through that here in just a little bit. But the Roth IRA comes out completely tax-free. So let's say that you put $1,000 in there, and somewhere down the road it turns into $10,000. Well, instead of getting a tax break on the $1,000, you're going to get a tax break on the $10,000 when it comes out. And I'm a huge fan of the Roth IRA because I love the idea of being in retirement and not having to worry about taxes. And the reason that I tell you that is I see this all the time. I see people who have been diligent, aggressive savers during their working years, and they put money away in their company retirement plan. And when they get to retirement, all of their money is in an IRA or a 401k type of investment, and they don't have any money sitting in something else. And so every time they need $1, there's a tax that comes with it. And I can just tell you from experience that that gets tiresome for people when they're retired. That if a client calls me and says, I need $20,000 for a car, we might have to take $25,000 out of their account to get them $20,000 because of the tax that's involved with it. With an IRA, if they needed $20,000, or with a Roth IRA, if they needed $20,000, we just take $20,000 out, and there's no tax that comes along with it. So anyway, I'm just a huge fan of it. If you don't have a Roth IRA set up for yourself, I would strongly recommend that you consider doing it. And as long as you're willing to take the hit on taxes now and not get a tax break on the money, as long as you're willing to do that, I think people that go into retirement with money in Roth IRAs are going to be some of the happiest people. And it just reduces a lot of different stresses on them. And so I'm a huge fan of the Roth IRA, and would highly recommend that if you don't have it, that you add that to your lineup of choices. And so anyway, that's my story on the right bucket to be in. And typically, if I'm working with a client and we're talking about all of their money, they've got multiple buckets. Your checking and savings accounts are buckets that you use at the bank. The next bucket that you might use is just a regular taxable account that you could get to at any time, but we can manage investments inside of that fella. And then after that is going to be a Roth IRA or a regular IRA or a retirement account. And so one of the ways that I look at managing money is your first line of buckets is your bank accounts and your savings accounts. Your next line of buckets are going to be investment buckets, but one of them might be taxable that you can get to at any time. And then there's going to be some tax deferred ones that we've got an eye on retirement. And so if you do that right, you just got money in different layers that are for different purposes. And we may manage them a little bit differently depending on what your time frame is and what your needs are for that money. So let's see. So one of the questions that I get, and we'll get to a point where we ask questions here in just a minute, so that I'm not just running on and we get to what it is specifically that you want to talk about. But every 4 years, I get asked by my clients every time I talk to them, what do you think the presidential election is going to do to the stock market? You know, what does that mean? And the truth is we really don't know ever. But I was fascinated 4 years ago about this time. The stock market dropped pretty hard in the 2 months before the election, and then it kind of caught its feet and was okay after that. Usually when there's a presidential election, the people on Wall Street can say, well, this side is wanting to cut taxes and this side's wanting to increase taxes, so here's what it means if one or the other gets in. And we don't have that as much this year because of all the action that's taken to support the economy during the pandemic. I don't think anyone is assuming that we're going to cut taxes going forward. I think most people are under the impression that taxes are probably going to go up in one way or another to help pay for all the action that the Fed took earlier this year. So the short answer is we never know, but that leads me to another topic that I like to talk to people about, and one of the things that I think makes investing hard these days is all the noise that you see on TV. The 24-hour channels that are talking about all the different breaking news stories and the second-by-second things that are happening in the investment world. And the way I describe things like that is they may be interesting, but they're probably not meaningful most of the time. And so when it comes to making decisions on what investments are we going to pick and how are we going to maximize your return, we want to deal with facts that are meaningful, that have some real impact on whether the market goes up or down, and not just the day-to-day noise. And there's just so much of it out there today. I think it distracts people a lot. And so trying to decide if something is meaningful and not just interesting, I think is an ongoing challenge for a lot of people. So depending on what happens with the presidential election, it may have a very minimal impact. It might have some impact in a very short term over weeks or a couple of months, but it may not have a significant impact over time. And so it may not be worth our time and energy to figure out, do we adjust investments based on that. So So the next thing that I want to talk about, and then we'll stop and give you a chance to ask some questions, because we can talk through anything that you want to talk through. One of the things that's changed this year is some of the tax laws around inheriting qualified accounts, and qualified accounts are IRAs and 401ks and things of that nature. So if you know anyone who is inheriting IRAs or 401ks or anything like that, the rules have changed significantly starting in 2020, and they're the rules around how you have to take those distributions out. And the tax consequences are a lot more severe now than they were just 10 months ago. And so If you know somebody that's inheriting an IRA or a 401k, the tax implications are completely different now than they were just a year ago. And so that's going to be an important thing for people to pay attention to. And I know that's a little bit of a one-off for people, because not that many people are in a situation where they're inheriting assets. But if you know of somebody, you may want to mention to them that, hey, the tax rules have changed. And essentially, here's what they did. You used to be able to take out money if you inherited some money from a mother or father or an aunt or uncle, brother or sister, whatever it is. You used to be able to take those distributions off of those retirement accounts over your lifetime. And so for somebody that's got a 20 or 30-year life expectancy still, that's not a lot of money that you're taking off of. Well, the IRS changed the rules starting this year, and now you have to completely empty out those accounts in 10 years or less. So you've got to take it out at a much accelerated rate. So if you're still working and you have an income from your job and you're taking money out of a retirement account that's taxable, you're just piling money on top of money from a tax standpoint. And so there's some new strategies that we can use to deal with that. But the IRS did that specifically to generate some more tax revenue for the government. And that's it'll be good news for them and bad news for any of us that are inheriting those assets and having to manage the tax burden that comes with them. So that was kind of the last thing that I had for prepared comments, and we can open this up and for any questions that anybody has. I wanted to tell you a couple of things. If you're interested in having a copy of that article that I popped up there earlier on the Roth IRA, you just need to email me, or you can email Danny, and we can send a copy of that article to you. And then we've also arranged for you to have a copy of my book if you would like. Ordinarily, they sell at retail for $18 a copy, but we will send you a complimentary copy if it would be helpful for you. And you just need to send me an email with your mailing address, and we'll put a book in the mail to you. And what this book will do for you, it's really just a story. It's told in story form. It's about 100 pages long, pretty easy read. But the whole point is to understand how the business works and understand the questions to ask, because not all advisors are operating under the same set of rules. Some of them are working as a fiduciary for you, which means that everything they do has to be in your highest and best interest. Some of them are just a salesperson for their company. So whatever their company wants them to sell, that's what they're there to do. And they don't always have to disclose that to you. And that's what I talk about in the book a little bit. And then the last chapter of the book has questions that you can ask to determine which one of those people you're dealing with, and so that you choose somebody that's gonna do everything in your highest and best interest, and not just try and sell you something or get you into a lineup of investments. So if you'd like to have a copy of the book, we will send one to you for free if you'll just send me an email with a mailing address. So that's kind of all I had for prepared comments, but we can talk about and answer any questions that you've got, and I'll stay on and talk as long as people want to talk. So Danny, I don't know where you're at, but if you have the ability to open up for questions, I'm fine with that.
Yes, so anyone who wants to unmute themselves and just ask away. Also, I put Paul's email in the chat if you wanted to shoot him an email about the book and article.
So if you've got a question that you want, feel free.
Hey, so I don't know if anyone else has questions. Can I chime in real quick?
Please.
So thank you so much, first of all, for doing this for us, because you have no idea how amazing it is to learn all of this.
Well, you're welcome.
So I read a little bit about Dave Ramsey and some of his investment and saving strategies, and I am a little concerned that maybe we're doing the wrong things. So I don't know if I don't know if it's even appropriate for me to ask, what is your opinion of some of the things that he teaches, or even if you're even familiar with it? And if you want to chime in on that at all, I mean, and if not, that's okay too.
Yeah, no. So first of all, that's a really good question, and I'm very familiar with Dave Ramsey. I don't agree with everything that he does, but I understand what he's doing and what he's trying to achieve. He's a big proponent in having no debt, and you know, and paying all your bills, and you don't pile up a lot of debt, and there's some parts of that I agree with, and some parts that I don't. But he's done a nice job for people. One of the challenges that I have with anybody that does this on a really big platform that's talking to very large groups of people is investment advice is so personal, and the answer is different for everybody, that I think it's really hard to come out and make some blanket statements that apply to everybody. So the things that Dave Ramsey does that I like, and let me preface this by telling you, so I'm here in Kansas City. I grew up in a little tiny town over by Topeka. And so I always think so much of my friends back home and how they would deal with some of these different things. And depending on where you're at in life, you know, how much money you're making, and how much support you have from spouses or parents or whatever it is. The things that Dave Ramsey talks about are really good basic building blocks. It's pay your bills, you know, don't carry a lot of debt. And I think that's fine, but there are also some other things that we can do. I'm not uncomfortable with having debt as long as you're able to manage it and not get overwhelmed by it. But there are a lot of people that just money management just isn't their thing, and so being super conservative and protective over your income and not having debt is a good thing. It's just not for everybody. But that's a good question.
Yeah, thank you so much. That was actually the main point that I was curious about. So thank you for pointing that out. I appreciate it.
Yeah, so his, you know, he'll say, don't have any home mortgage debt. He'll certainly say don't have any credit card debt, and it's hard to argue with that because the credit card companies charge such enormous interest rates. But for some people, having a little bit of mortgage debt is probably okay as long as they can manage it. So. Does anybody else, or Elizabeth, do you have any other questions, or anybody else have anything on your mind that you want to talk about, a topic?
I'll jump in. This is Amanda, Paul. I was actually talking to a friend recently about kind of the maximums that you can put into a Roth and a 401k. I've
Yes.
never really wrapped my head around it, and if employer contributions contribute to that maximum. Can you tell us what the maximums are and if that plays a part?
Yeah, so the maximums on an IRA are you can put away $6,000 a year in 2020. If you're 50 or above, there's a catch-up provision that allows you to put another $1,000 in, so you can put in $7,000. So you can put in at least $6,000 and up to $7,000 in an IRA. And in a 401k this year, you can put away $19,500. And if you're over 50, you can put another $6,500 in on top of that. So that gets you up to $26,000 that you can put in. And that does not include an employer match. So that's your money. You can put away $19,500 if you can save that much money into your retirement account. And you can do that every year. And that does not include your employer's contribution amount. Does that make sense?
Yes. Because I have, I know through my company, a Roth and a 401k option. And so I put it in the Roth first because my dad recommended the same as you. And not that I am lucky enough to be able to contribute the maximum, but just wanted to, have some goals to shoot for.
Yeah, that's wonderful. So we didn't talk about this, but new in the last several years in the 401k or company retirement plan world is this Roth option. It used to be everything you went in that you put into your retirement account went in with, and you got a tax break on it, and that was great. But they started offering this Roth option, and I'm just a huge fan of those things. So I'm glad to hear that you're doing that. The other thing that I'll tell you is I've been doing this for 24 years, and my background, I suppose I probably should have said this up front. I have a degree in mechanical engineering and a master's degree in business. And so my education is really heavy in math and statistics and analytics and things of that nature. And so I love doing this stuff. I love looking at these things and trying to figure out, to me, it's a big puzzle. But one of the things I've learned about myself watching me do this for the last 24 years is that I'm a huge proponent of balance. And so if you're killing yourself to put everything into your company retirement plan, but you're not saving for short term or you're not saving in other ways, you're going to end up being a little bit out of balance. And so I look at balance probably first when I'm looking at people's assets and where they are, just to see if we've got things in the right places. But good for you for doing the Roth option in your company plan.
Thank you so much. I appreciate it.
You're welcome.
I just have a quick question that basically has to do with the Roth IRA, but if you're married, is the maximum per person different for contributions, or is it still just that 6,000?
So it's still the 6,000. So IRA stands for individual retirement account. So that's for each person. So if you're married, you could put 6,000 in an IRA, and your spouse could put 6,000 in an IRA. So you could put away 12,000 a year if you're under age 50, and depending on which type of IRA you put it in, there are income limitations. So if you make too much money, you can't deduct it. If you make too much money, you can't put it in a Roth IRA. And so there's different rules around eligibility. But every individual can do 6,000. And if you're 50 or over, you can do 7,000.
Okay, thank you.
That answer your question?
I think so, but I think I should probably email you to set up a time to talk also,
Yeah.
since it is
Well,
individual.
I would enjoy that. So please do.
Yeah. Well, thank you.
You're welcome. All right, what other questions do you have?
I'll jump in with a question. My name is Jessica, and yes, thank you for doing this.
You're welcome.
I recently got a new job, and now I work at a nonprofit company. So instead of 401k, they have, I think it's a 403b.
403b, yes. Yep.
Yes. So I have a 401k through my last company, but I'm not allowed to put it in with the 403b. So my 401k is still just sitting there. So the first part of my question is it okay to just leave it sitting there? And then my second question is there anything special about a 403b that's different than the 401k?
Okay, so those numbers, 401k and 403b, those are just the identifiers for the tax code that talks about the rules associated with it. So for companies that are for-profit companies, Section 401k of the IRS tax code says this is how you can do a retirement plan. For not-for-profit companies, Section 403b of the tax code says this is how not-for-profits can do retirement plans. And there used to be some differences in the types of investments that not-for-profits could use as opposed to for-profit companies, but the general idea is the same, and that is that you're putting money away for retirement, and so they're going to be very similar. So I would recommend that if you were participating in the 401k where you were at, go ahead and feel free to participate in the 403b plan at your new not-for-profit. So your question about leaving an employer and having a retirement plan with them is probably the most common question that I get, because this happens all the time, right? People change jobs. Sometimes I meet people that have changed jobs 3 or 4 times, and they have 3 or 4 401ks at different companies, and they just left them there. And most companies will allow you to do that, but then it's on you to stay on top of each of them and manage the investments through there. One of the things that I explain to people about 401ks, that one of the differences between a 401k and an IRA, an individual retirement account, is in a 401k, the company might give you 15 investment choices, maybe 20 investment choices. In an individual retirement account, you can invest in thousands and thousands of different things. And so there's a much broader range of choice and quality of investments that you can use in an IRA. So one of the things that you can do instead of leaving it in the 401k is you could roll that 401k into an IRA and either manage it yourself, or you can find somebody like me that helps manage those things, either whichever way you're comfortable with. So you can do that, and then you can still add money to your 403b and participate in that fella. So does that answer your question?
Yes, it does. Thank you very much. Very helpful.
Okay. Something else I'll tell you guys that may or may not be important to you. So I do this for a living, so I charge a fee to manage money. But I also do a lot of work for people for free for a couple of reasons. Number one, because I like it. It's just a puzzle to me. But number two, I call them get to know you services. So I do a lot of research and work for people. And if they like me, they figure out a way to work with me over time. And if they don't, they just keep moving. But for my clients that I manage money for, if they have money in a 403b or a 401k, I'll actually look at that and help them create the allocation inside of that account. And so if any of you on this call want some help with your company retirement plan, I don't charge to do that. The investment choices that you have, I probably already know them just because I'm pretty familiar with a wide range of investments. And if you would like some help just looking and saying, hey, is this allocation okay? Does this make sense? I'd be happy to help any of you with that. And I suppose the other thing that I could add is Danny probably knows me better than anybody because I manage money for her. And so she knows who I am and what I do and how I do it. And so if any of you want to bend her ear on any of that, then that's probably not a bad idea too. So, all right, who else has a question?
I'll ask another one, Paul. This is Amanda.
Okay.
If there were like some stepping stones to take, like I know you mentioned getting 6 months of savings, of your expenses built up in your savings was good and contributing to your 401k or retirement account. Are there other steps that you would recommend if you kind of check the boxes on starting on those 2 areas that you would recommend?
It depends on somebody's situation, but we would look at a lot of different things. Having an emergency savings is a good idea. Having some retirement savings is a good idea. Paying attention to any credit card balances that you're carrying or any other debt. I like to look at that for people and show them, here's the strategies on how I would attack your debt, and here's the order that I would do it in, and here's the reasons why. But when it comes to the saving side of it, having your emergency fund built up is a real good idea. And then just starting to invest. The people that seem to have the most success with this over time are the ones that just put a little bit of money every month. They just figure out how much it is and just start putting it away, because after a while you won't miss it, and it'll build up your balances over time. And depending on what that money is what the objective is for that account and those funds, we'll pick different investments to kind of meet those goals.
Great, thank you.
You're welcome.
Paul, it looks like we had a question in the chat that said, do the inheritance tax laws change every year?
No, in fact, they haven't changed in a very long time. And it took advisors off guard a little bit, and it irritated us a lot because it completely, you talk about upsetting the apple cart, it completely changed the way the strategies that we have to use for clients to help minimize taxes. So that's a really good question, but it hasn't changed in a very long time, and it's causing some headaches for not only just for the advisors, but for the people that are inheriting money. And so that is a one-time change that, money grab's probably not the right word to use in that situation, but it's literally, they knew that making that change would create a tremendous amount of tax revenue for the government. And I think they were just looking for ways to bring a little bit more money in. So.
I have a question, a quick question.
Okay.
So if you inherit a trust, what does that really even mean?
Okay, so a trust is a special bucket that was set up, and if you're saving money for retirement, you use IRAs and 401ks and things of that nature. But for your other money, you can just put it, if you're married, you can put it in a regular joint account in both of your names, or if you're a single individual, you can have a single account. And a trust is another version of those things that does different, that has some different benefits. So for example, if you have a taxable investment account or a joint investment account, and you pass away, those accounts are actually open to public records, so people can look up and see, what your assets were and things of that nature. And they have to go through the probate court process to get passed off to the beneficiaries or the heirs. So a trust will do a couple of things. Number one, it allows you to pass out your assets based on specific wishes, and it makes your affairs private, so people can't see what goes on inside a trust. It bypasses the probate process, and so just to give you an example, so I'll have a client that comes in and they've got this client will be in their 70s and they've got 3 kids in their 40s or 50s, and one of them has had a drug problem and just can't seem to get their life together, and so instead of just dividing their assets by 3 and giving each kid a third, they'll set up a trust, and they'll probably give some assets to the 2 kids that are relatively stable. But for the third one, instead of just giving them a pile of money that they're afraid they'll go through, they may set up some provisions in the trust that says they can have $40,000 a year for the next 10 years or whatever it is. So a trust allows you to do some things that are a little more specific. So it's not unusual if someone has a trust, if you're inheriting a trust, that whoever had the trust probably also has an IRA somewhere or a 401k somewhere, but a trust is just a bucket that has some specific rules. And so it's a relatively straightforward thing if you're inheriting it. But we can talk about that some more offline if you want to.
Yeah, thank you. I appreciate that.
Okay.
Paul, we have a really awesome question in the chat, and it says, because of COVID, my company is no longer matching 401k.
Yes.
This happened before I was in a position where I could contribute. How important is my company matching, and should I be looking for another job?
So first of all, so can I see the chat stuff? I'm kind of an old guy, so I don't know all this stuff inside and out. I think I'm finding it over here. So first of all, a lot of companies are eliminating their match during COVID, and it's just a sign of stress on the companies. But if I owned a company and I had a lot of employees and I had a big 401k, when things get bad like this, you start figuring out, if you care about your employees, you start figuring out, what can I do to keep people employed and not have to lay them off or furlough them. And so what are the things that I can do first to save a little bit of money? Well, getting rid of the company match will save the owners some money and hopefully keep them from having to lay off people. But businesses have been under so much stress because of what's happened this year that a lot of companies they're either eliminating or suspending their match. Most of them are just suspending it for a period of time. That doesn't mean that the company's bad or anything like that. That just means that they're doing everything they can to survive. But for you, that it's much less attractive because a company match is the most beautiful thing ever because it's just free money. You know, if somebody's matching 3%, if you put away 3% and they match 3%, you've essentially doubled your money risk-free. There's no way that I can do that for my clients. I can't say, look, I'll double your money every year and no risk. And so a match, if your company is matching, you just almost need to figure out how to put away enough money to get that match because it's just free money. And if they're not matching right now, that's not a surprise. It's a sign of the times that we're in. And if they're a good company and a good employer, and they get back on their feet, they'll do everything they can to put that back in place. But having said that, you know, you can think about doing other things like Roth IRAs and things of that nature. So there are some other things you can do with your money because missing out on the match is just, if you've got a match, that's just fantastic. And if you don't, it's just less attractive compared to some other things. Danny, did I cover everything that was in that question?
Yes, I believe so. That was a really good answer and question because I guess I didn't even think of that. So your perspective on it, that, you know, they're doing everything they can to keep paying their employees versus laying them off. I think, you know, it could potentially be a red flag, but it's actually signs.
In normal times, it would be a red flag. If this were not COVID, if this were not 2020, that would be a red flag. But this year, it is happening across the board with companies, and it's just a sign of just how hard things are. And some of those employers are good employers that are doing everything they can do to not lay off people or not. You know, it's just the lesser of two evils kind of thing. Oh, I see a question here. In your opinion, would you prioritize paying off student debt before purchasing a home and getting into a mortgage? And so my answer to that is going to be a balanced answer. And I think that, excuse me, I'd probably want to talk some more about somebody's situation, but you know, sometimes student debt is so big that if you focus on paying that off before you do anything, it's going to be a ways down the road before you get to start living your life sometimes, depending on how much that is. And so I would probably, to answer a question like that, I would be a proponent of balance, and I would be a proponent of paying off some of the student loan debt. But if purchasing a home, if it's part of, you know, if you're trying to raise a family or something like that, having a home's an important thing. Now, if you're young and you're just out of college and you're early on in the process, there's nothing wrong with leaning into paying off those student loans as hard as you can early on. But I hate to see people do that at the expense of not living their life. But that's the type of thing that I would want to see the numbers and talk through it with somebody to help figure out the best way to go about that. So, but that's a good question. All right, let me see what else is in here. How come nobody's asked me what the stock market's going to do in the next year or so, now that we've had this pandemic thing?
Oh gosh, do you have that answered?
Yes, I do. Of course I do.
What? Do you have a magic 8 ball?
I have clients tell me all the time, it's like, okay, here's what I need. I need you to make me 20% a year. I really don't want any risk, and I never want this to go down. And I tell them, I go, I have a plan for that. It doesn't actually work, but I have a plan for that. But I can tell you, first of all, anytime someone tells you that they know what's going to happen next with the stock market is full of it. But I can tell you my opinion on what I think is going to happen from here. And it's kind of the scenario that I'm using to guide where I go with clients. So number one, here we are in 2020. This is a completely unique investment world that we're living through. And when the market was dropping hard in February and March, I've never spent more time staring at the market second by second as I did in the month of March, trying to make sense of what was happening. And it was fascinating for me to watch people try to say, oh, this looks just like the dot-com bubble in 2000, or this looks like the financial crisis in 08. What we just went through has never been experienced from a stock market standpoint, just ever. There's just never been a situation where we've just said as a country, all right, everybody turn out the lights and go home, and we're shutting her down. And it just created just a real panic in everywhere, but including with investments. And so in February and March, usually you build an allocation of investments because when these things are good, these things are bad, and they balance each other out. But when people are panicking and they're selling everything, it doesn't matter what it is. And so in February and March, we had people selling everything and all they wanted was cash. People were even selling U.S. Treasuries just to get cash, which is crazy because the U.S. Treasury is considered to be the safest investment that there is. And so that's just an idea of how much panic there was. Well, the Fed came in and moved so fast to cut interest rates and to make some of the changes that they made to support the economy that it really helped the market. So in April and May, the market popped back up. So I tell you that to tell you, so that's where we came from. I tell you that to tell you where I think we're going. I think we're finished with the extreme volatility down. I think we're finished with some of the extreme volatility up. And I think the next year or two is just going to be a grind. I think the market's going to be more up than down. I think it'll be more green than red, but I think it's going to be a grind. And it's going to be a grind because there's going to be a lot of bad news out there. There's going to be, unemployment's going to stay up. There are going to be companies that have gone out of business that won't ever come back. And there's going to be a lot of bad news like that to drag the market down. But there is also a tremendous amount of cash on the sidelines, and there are a tremendous number of investors that when the market goes down, they'll come in and buy and prop it back up. And so I think you're just going to see it grind up and down and up and down, but it's going to grind up more than down. So I think we're still going to make money, but it's just going to be a struggle. And so the other thing that I think is really going to support the stock market in terms of investments is whenever the Fed does something like they did, where they took interest rates and they said, well, we're going to push interest rates down close to zero, and they did that fast. They do that on purpose to support the stock market because they want people to get out of their bond and savings account investments and put their money over into stocks. And one of the most famous sayings in the investment world is don't fight the Fed. If the Fed wants you moving towards stocks, you might as well go because that's where people are going. And that's what's been happening lately is there's no place else to go with the money. Savings accounts aren't paying anything. Bond funds are paying less. And so the fact that the Fed dropped interest rates like that is going to support the stock market over time too. So my take on the market over the next year or two is that it'll be higher a year from now. It'll be higher 2 years from now, but I think it's going to be a grind. And I don't expect it to be a huge money-making opportunity necessarily, but it's still probably the best place to go with your savings over time. So that's my story on where I think the stock market's going. Who else has a question? Danny, are you still there?
I am. It's 7 o'clock.
It's 7 o'clock. So what does that mean? Are we done? I can keep talking if people want to talk, or we can talk offline too. So, but if we have a time limit to stick to, that's fine too.
We usually stick with the timeline unless there was one more urgent question. Otherwise, I just wanted to say thank you for everyone who hopped on tonight and gave Paul or carved out time for Paul. And thank you, Paul, for just sharing such awesome knowledge with our league members. We've had some really awesome questions tonight, even ones that I never thought of. So definitely this is going to be so helpful for people just understanding, how their money can grow, what types of accounts to use. So yeah, if there's anyone maybe who has one more question, if not, we will just wrap up for the night.
And it was my pleasure. And any of you that have specific questions, feel free to contact me and just tell me who you are and how we've met so that I know. But I'm happy to help you talk through anything that you want to talk through.
Perfect. Well, everyone, if you didn't catch Paul's email in the group chat, it is paul@boulderkc.com. And when you shoot him an email, if you wanted his IRA article or a copy of his book, you can just put in the subject line of the email, Junior League training follow-up, and then just, as he mentioned, give him your address if you want that mailed to you. And that's all we have tonight. And thank you guys so much. And Paul, you're fantastic. Thank you.
It was my pleasure. Thank you all very much.